Have you ever noticed something strange about silver? It doesn't fall when everyone is scared. It falls when you finally start feeling okay. You watch it climb from $70. You watch it break $100. You see it hit $121. And for the first time in months, your chest loosens. You think, this is it, the new normal. You text your friends. You maybe even buy a little more at the top because it feels safe. And then, in a matter of hours, it vanishes. $121 becomes $99. A 15% drop that feels personal. If your stomach sank when you saw those red candles, or if you felt that sudden tightness in your chest, that's not weakness. That's biology. But if that sounds familiar, stay with me because this isn't random. There are 3 specific gears turning behind the scenes right now, from a trading desk in Chicago to a port in China, that explain exactly why this happened. Today we're going to look at the anatomy of a crash. We need to talk about the uncomfortable truth regarding the CME margin hikes, the export restrictions coming out of China, and the massive rally that blinded everyone to the risk. But more importantly, we need to talk about you, because in moments like this, there are 2 types of people. There are those who see a 15% drop as a catastrophe, and those who see it as a mathematical inevitability. The difference isn't luck. It's understanding the game board. Let me explain this. Before we dissect the crash, we have to look at the climb. Silver didn't just appear at $121. It rallied 269% from a low of $70. Now pause for a second. Think about the last time you made almost 300% on anything. When an asset moves that fast, it creates a specific psychological environment. It creates a feeling of invincibility. When prices go vertical, people stop buying value and start buying momentum. They pile in with money they can't afford to lose using leverage they don't understand. They aren't investing. They're chasing a green candle. And when you have that much leverage in the system, when everyone is betting on the price going up forever, the market becomes fragile. It's like a tower of Jenga blocks. It looks tall, it looks impressive, but it's mostly air. This is where behavioral math kicks in. The market has a way of finding the maximum pain point for the maximum number of people. To clear the board for the next move, it needs to shake out the people who are just there for the ride. And to do that, it usually needs a trigger. Here's the uncomfortable truth about what happened this week. The CME, the Chicago Mercantile Exchange, raised the margin requirements for silver futures. If you don't trade futures, let me explain this simply. Imagine you want to buy a $100,000 house, but the bank says you only need a $5,000 down payment. That's leverage. You control a massive asset with a tiny amount of cash. But when volatility hits, the bank, or in this case, the exchange, gets nervous. They tap you on the shoulder and say, the game has changed. We don't want $5,000 anymore. We want $10,000. And we want it by 4 p.m. This is a margin call. When the CME hiked margins, thousands of traders who were leveraged to the hilt at $121 suddenly had a choice: deposit more cash immediately or sell their position. Most people don't have extra cash lying around during a panic, so they sell. And when they sell, the price drops, which triggers more margin calls for the next group of traders, which makes them sell. It's a cascade. It's a forced liquidation. This drop to $99 wasn't because the fundamental value of silver changed overnight. It wasn't because the metal stopped being conductive or useful. It was a liquidity flush. The market was punishing the greedy to reward the patient. That's not market genius, that's just mechanics. The exchange raised the cost of poker, and the people with weak hands had to fold. Section 3. The supply shock. China's export ban. But if the margin hike was the match, the fuel is something much more fundamental. While the paper price is crashing, the physical reality is tightening. We are seeing significant export restrictions on silver coming out of China. China is a massive player in the industrial metal space. When they restrict exports, they are effectively hoarding the physical metal for their own solar panels, their own electronics, and their own strategic reserves. Here's what makes this powerful. The paper market, the one crashing on your screen, is reacting to leverage and margin calls, but the physical market is reacting to scarcity. There's a disconnect happening. The price on the screen says silver is worth 15% less than it was yesterday. But try to go out and buy physical silver in bulk right now. The premiums tell a different story. This is the signal amidst the noise. The export restrictions suggest that the long-term supply crunch is real. The industrial demand isn't going away just because a few traders got liquidated in Chicago. Most people miss this next part, but it explains everything. Institutions love these drops. They don't chase green candles. They don't panic on red days. They wait for the margin calls to wipe out the retail traders, and then they step in to buy the physical assets at a discount. They know that China's restrictions are a long-term driver. They know the physics of supply and demand eventually win out over the psychology of fear. Section 4. Living inside volatility. So where does that leave you? You saw $121. You see $99. You feel that urge to fix it, to do something, to stop the pain. But here's the turning point. That anxiety you feel, that's not investing, that's living inside volatility. If you're losing sleep over a 15% drop after a 269% rally, you are likely overexposed. You're trying to time the ocean. The market rewards calm. It punishes panic. Real wealth isn't made by guessing the top. It's made by understanding that volatility is the price of admission for high returns. You cannot have the 269% rally without the 15% correction. They are two sides of the same coin. Do you become anxious or grounded? Do you chase noise or build quietly? The drop to $99 is a test. It's asking you if you believe in the thesis, the industrial demand, the supply constraints, the monetary debasement, or if you just like the green numbers on your screen. Conclusion. The margin hikes will pass. The leveraged traders have been washed out. The Chinese export restrictions will eventually squeeze the physical price higher. But the story isn't the price. The story is who you become during the swings. If you can look at a 15% drop and see it for what it is, a mechanical flush of leverage, not a fundamental break in value, then you have an edge that no algorithm can beat. Time favors whoever needs money the least. Don't let the noise shake you out of a generational asset. Stay calm. Stay liquid. I'll see you in the long term.